Foreign exchange options presented by Group 1. Options give investors many opportunities to limit risk and increase profit. In this presentation, we will discuss what options are, how they are used, and which strategies you can use to make a profit. First up, we have stock options. Let's get started. Stock options began trading on the Chicago Board Options Exchange in the early 1970s. Nearly 50 years later, approximately 4.3 billion listed option contracts are traded annually, in which 89% of 2015 were stock options. These listed options exchanges are extremely prominent in the investing community and are constantly adding new dimensions to the world of trade. In order for investors to be successful, it's crucial that they have a complete understanding of the essential qualities and strategies of stock options and how they should go about using them. Stock options, or share options if you're using the European measures, are a type of currency exchange options that are used within a market to limit buyers and seller risk, all while maximizing their profitability. A stock option is a privilege sold by one party to another party that gives the buyer the right, but not the obligation, to buy or sell an underlying asset, such as common stock, at an agreed upon price within a certain period of time. So, the main benefits of options are the leveraging power and the profitability. So, the leverage of options allow investors to use stock replacements to earn large profits from small movements by only investing a small amount of money upfront. So, though there are many advantages and benefits, the main disadvantage is that the holder has no ownership benefits, no rights to the stocks. So, as well, the other disadvantages is that they have no interest or dividend income and the time value decay. Since they're contractual and they have expiration dates, they have to sell or buy by those dates or else they'll lose out on their investment. So options and stocks, they're both securities that are subject to contractual agreements. So it's pretty much up to the investor to decide which of the two is best for them. Now that we've learned about what stock options have to offer and the benefits and disadvantages, let's move right along to call options.
So, for my part of the project, I had to focus specifically on call options, which is a certain type of stock options. A call option is a contract between two parties that gives the buyer the right to purchase a stock at a specific price before the expiration date. A call option is usually used when it is believed that um, the underlying asset will increase in price. A call option is sometimes used for investors and is really important for profit, tax management, and generating income. Next, I'm going to explain how a call option basically ties into lost profits and a break even point. As you all can tell, this is a graph of a call option. Looking at the graph, the x-axis represents price, while the y-axis represents profit and loss. To begin, it is evident that the break-even point is the point where profit is equal to zero. In other words, the break-even point is the point where the stock price and the premium paid are added together. Above the break-even point is unlimited profitability. This means that inside of a called option, the profit for this option will always increase, which means that the profit doesn't have a limit towards it. The stock price at the expiration is the last value on the x-axis. Anything below the break-even point is a loss. However, the loss can never pass the call premium, which is a good thing because unlike the profit, That means that the loss is limited.
From the graphs and data incorporated in the last section, you should now have a brief understanding of call options. Now let's move on to put options.
Hi, my name is DeRay Freeman, and I'm going to give you a few takeaways from my research on how put options can be profitable to investors. So first off, a put option is the right to sell, not obligation, an asset at a certain price within a certain time frame. Now that price is actually called a strike price, and it's agreed upon both parties, the buyer and the seller. So let me briefly talk about how each side can make some money. So for the buyer side, let's just say the stock price is set at $50. And let's say the strike price is set at $100. Now, the buyer, he wants to have a bearish assumption. It means the stock price is going to go down. The stock price goes down, that difference between the stock price and the strike price, wherever it is by expiration, will determine how much profit the buyer would then receive. Now, as for the seller side, let's say that it's actually opposite. So if the stock price was set at 50 for the seller, and the strike price is still at 100, the seller actually wants this stock price to go up. If the stock price does go up, the seller then won't be obligated to sell the asset or the security to the buyer, and then it can just reap all its benefit. But the most amount of money that the seller can make is the premium that was paid by the buyer in the beginning of the contract. Soon as the buyer enters into the contract, the buyer must pay that put premium, and that's the most amount of money that the buyer can lose. So if the buyer decides not to exercise, then it will just lose that premium, and the seller will gain the premium. Now, if the buyer does exercise, whatever that difference is between the strike price and the stock price times the amount of shares, that's the amount of money that the buyer will then profit. Now, a trick with the seller is if the stock price goes down, benefiting the buyer, because it is a zero sums game where one person gains, the other person loses. But if the contract is actually benefiting the buyer, the seller can go try to purchase the asset at that lower price, and then come back into another put option contract and try to sell at a higher price. We'll just re-monitor the market, whether the stock price will go up or down. So that's basically it with put options. And so the main takeaway from the put option, I'll say, is most important that the investor really thinks about how the market will perform and come up with strategies and other alternatives just in case it faces a loss.
Our last presenter did great explaining buying and selling put options. Let's move on to our last section, single payment options.
Single payment option, also known as spot, allows the investor to specify two things. One, the conditions in which the investor receives the payout. Two, the size of the payout. In this type of currency trading, the contract is settled in cash immediately, as it automatically converts the option to cash once the trade is successful. This type of arrangement is often referred to as a binary option because there are two possible types of payouts for the investor. First, the agreed upon payout, if both parties' conditions are met. Second, nothing at all. The event doesn't occur and the investor loses the full premium to the broker. The broker that provides this product will determine the likelihood that the conditions will be met. In turn, he or she will charge the commission they feel appropriate. Type of option product is often found in the Forex market. For example, if a trader believes that the euro US dollar will not break below 1.3 in 12 days, he or she will pay a certain premium to a broker and then after the 12 days collect the agreed upon payout, if the scenario is correct. However, if the euro US dollar does break below 1.3 in 12 days, the trader loses their premium to the broker. Many traders enjoy the additional choices that the spot option gives its traders. Spot options are easy to trade. It's a matter of entering the scenario and letting it play out. If you are correct, you receive cash in your account. If not, your loss is the premium. Another advantage of spot options is that spot options give a number of different scenarios, allowing the trader to decide what he or she thinks will happen.
This presentation discussed the different types of foreign exchange options and how they can be used to ensure minimum market risk while maximizing profitability. Knowledge of these options are very important to investors so that they have an equal playing field in the foreign exchange market. Thanks for watching.